So today we're talking about three standards, IS 8, IS 10, and IFRS 13. Now, the reason why we're talking about these standards together is because with questions a lot of times, these standards are not tested individually, but they are tested with other questions. When an examiner gives you a question on PPE, for example, it could give you something that relates to a change in accounting estimate of the PPE. This is where IS 8 comes in. Or it could give you a situation where there is a significant event after the reporting period. This is where IS 10 comes in. Or it could give you a situation where there is more detail when valuing the PPE using fair value. And that is where IFRS 13, fair value measurement, comes in. So sometimes even these three standards can be tested together at the same time in a question with another fourth or fifth standard. Okay, so let's look at IAS 8. IAS 8 covers accounting policies, changes in accounting estimates, and errors. So what are these different things? Accounting policies are basically the principles and rules. Every single thing that you are learning about the standards, the accounting policies, those are rules to follow when preparing financial statements. A change in accounting estimate is simply a change in the carrying amount of either the asset or liability or related expense. And this is usually because of reassessing the future benefits or obligations associated with that asset or liability. Now, for errors are simply mistakes in the financial statement. And prior period errors are mistakes. Those are misstatements or omissions in the financial statements of prior periods as a result of not using reliable information that should have been available at the time. So those are errors. How do we treat these three different items? That is what IAS 8 talks about. Now, what are the principles that IAS 8 talks about with respect to accounting policies? Now, IAS 8 tells us that the respective IFRSs or IASs or standards determine what accounting policies are to be applied. And where there is no applicable standard or interpretation, you need to use your judgment and apply an accounting policy from the conceptual framework. So anytime you apply any accounting policy, because there's no specific standard about it, you need to refer to the conceptual framework, or you need to refer to IFRSs or IASs dealing with a relative issue or a related issue, or do both. Now, the standard IAS 8 tells us that we should only change accounting policies if a standard requires it, or if that change results in a more reliable and relevant information in the financial statements. Now, a lot of times when there's a new standard, right, and the new standard has new policies, the new standards will usually have what we call transitional arrangements. This talks about how to direct the transitional arrangements are arrangements where a standard lays out the rules and principles to follow when a new standard has been developed, when new accounting policies have been developed. Now, if there are no transitional arrangements that detail, oh, this is how to treat this particular change in accounting policy, then IAS 8 says you apply such change retrospectively. But what does this mean? Applying a change retrospectively simply means in the current financial statements that you're applying the change, just adjust the opening balance of each affected component of equity. That's the ordinary share capital, retained earnings. It's usually retained earnings that is affected anyways. And also adjust the comparative figures as if the new policy had always been applied. Okay? So you're simply correcting opening balances. You're not going back to the previous year's financial statement or the previous 2 years' financial statements to effect the change. Now, the standard says there's an exception to this rule, meaning there's an exception to applying a change in accounting policy retrospectively. Meaning, when it comes to cost and evaluation model, when PP is changed from cost model to evaluation model, this standard specifically says you treat it prospectively because that change is a change in accounting policy. You are changing the principle or the rule that you are adopting in your financials. But any other type of change, you apply it retrospectively. Okay, a change in inventory valuation from first in, first out to average cost method, you apply it retrospectively, meaning you correct the opening balances. a change in recognition criteria for assets, meaning maybe some assets don't qualify again to be assets, or some liabilities don't qualify to be liabilities, or some that didn't qualify before now qualify, you apply those changes retrospectively. You change from accrual basis to maybe cash basis or any other basis, it is applied retrospectively. Retrospectively, again, simply means going to the opening balances and adjusting for those changes rather than, opening a canker of worms to go to the previous year's financial statement. So the standard then talks about a change in accounting estimates. A change in accounting estimate must be recognized prospectively. Simply means you apply the change in the current year and in any future periods that are also affected by that change. So this is a normal change. This is a change in impairment of receivables, a change in depreciation method from straight line to reducing balance, a change in the value of a provision. Basically, change in accounting estimate is a change in the calculations of how you calculate, assets and liabilities, not necessarily the principles applied. Okay, all these things are still, the principles are still the same. It's just the calculation that will be determined, the figures that will be determined that are different. And IS 8 says that any material prior period error should also be corrected retrospectively. So if the error was made, let's say 5 years ago, 5 financial years ago, you just need to adjust the opening balances of the accounts affected in the current period to effect such prior period errors. Okay. Now let's talk about events after reporting period. What are events after reporting period? As the name suggests. Now, before I explain what events after reporting periods are, you need to understand reporting period in itself. What is reporting period? What does reporting period mean? Reporting period is simply the same thing as financial year. So if I prepare my accounts from January to December every year, my reporting period is January to December. So if I say financial year 2019, my reporting period is from January 2019 to December 2019. That's it. So any event after this date, after the end of this period, is called events after reporting period. So they are events that can either be favorable or not. And there are basically two types. We have those that are adjusting and those that are non-adjusting. The adjusting events are events that give new evidence. Non-adjusting are also events that give new evidence. Why? Because they both happen after the year end. They both happen after the reporting period. So they both give new evidence. But it's what they point to that differs. The adjusting event gives new evidence for conditions that already existed as at the year end. While the non-adjusting event gives new evidence on conditions that did not exist, meaning they give new evidence to new conditions. However, adjusting events give new evidence to existing conditions within the reporting period. Okay, so as the name implies, adjusting events require adjustments to the financial statement, while non-adjusting events do not. However, if the non-adjusting event is material enough, it needs to be disclosed. So adjustment here means you are changing the figures as it relates to that event. Now let's look at an example. For inventories or impairments, if you sell an asset below cost after the reporting date, it shows that that asset was actually impaired as at the reporting date. Okay. In practice, there could actually be new events that took place after the reporting date that is making them sell below cost. In such cases, it is a non-adjusting event. But for the purpose of the exam, right, all other things being equal, as long as the asset was sold below cost with no other qualification or information given, we say that what such event is an adjusting event, and you need to readjust that particular item. If it's inventory, remeasure it at lower of cost, cost and net realizable value. If it's PPE, you need to test for impairment. Now, for IFRS 9 is financial instruments. If a customer is owing you, you have a receivable, and that customer goes bankrupt after the reporting year, then the receivables should be impaired, should be adjusted for, because what receivables tell us is within the next 12 months, we're going to receive this money from this customer. But if before you prepare your financial statements, you already know the customer is not going to pay anyways, then you need to adjust it. So these are just other examples of adjusting events. They are the most common ones in the exam. A court case. a court case started before the year end, but it was settled after the year end. Okay, the settlement is the event and is the new evidence, but it's pointing us to what happened during the year to sort of give us a more accurate picture of what the provision should be. So it's an adjusting event. If the court case started after the reporting period, then it's a non-adjusting event because it's giving us new evidence to new conditions. Now, for non-adjusting events, there are quite a number of examples, and these are examples that the examiner would usually put in the question to make students try to figure out whether they are adjusting or not, when in the real sense, they are non-adjusting. Okay, so such examples include when you sell an asset or dispose an asset after the reporting date, okay? Or an obligation for a provision arises after the reporting date, meaning the obligation did not arise before. There are some times where the obligation arises before, but it's after the year end that something happens, okay? That will be an adjusting event. But if the obligation arises after the year end, then it's a non-adjusting event. If you sell an asset after the year end, or you buy an asset after the year end, it's a non-adjusting event. If you destroy an asset after the year end, or an asset gets destroyed by a flood or fire, it's a non-adjusting event. However, for these non-adjusting events, if for whatever reason they are material, then you need to disclose them in the financial statement. Now, there are some principles you need to know about events after reporting period, and it is if after the reporting date, management decides to liquidate the entity or cease trading, then the financial statements cannot be prepared on a going concern basis, okay? Meaning anything that affects going concern is an adjusting event automatically, okay? And which brings me to this next point, to say any non-adjusting event, right? It could be a sale. Imagine if you sell an asset, right, after the year end. It's a non-adjusting event. But imagine if you sell 80% of your assets. Now, 80% has given rise to a going concern implication, meaning it's possible that this company is no longer a going concern. That's why they're selling the majority of their assets. So in such case, while you will not adjust for that sale in your books because it's a non-adjusting event, that particular sale has triggered a going concern issue, and your financial statements will be prepared on a breakup basis. So in such case, the non-adjusting events will not be adjusted for. However, the mode of preparing the accounts will be adjusted for because it has affected the financial statements going concern status. So let's talk about fair value measurements. Now, every time you've seen a standard on an asset or a standard on liability, and you see the word fair value, fair value, fair value less cost to sell, fair value, net realizable value, fair value, fair value. Every time you've seen fair value mentioned, that fair value is not just, oh, what are we going to get it? What price are we going to get in the market? That's not all fair value is about. So there's a dedicated standard that addresses how we should determine fair value, how we should think about fair value, right? So the standard says that fair value is the price that would be received to sell an asset, meaning you are the one doing the selling, okay? Or paid to transfer a liability. Sometimes some people believe that fair value is the price that will be paid to buy an asset. Not necessarily, right? That's why it is a very, very specific definition. It is the price that will be received to sell an asset. And you are the company that is trying to determine the fair value is the one doing the selling, because we're looking at fair value as the value of selling that item, the item that you have currently, okay? Because the item that you want to buy, so people say, is it not the same thing? Not necessarily. It's not the same thing in all cases. There are some cases where the item that you want to buy is different from the item that you want to currently sell. Maybe due to the age of the asset, maybe due to the version, due to so many things, okay? Due to market conditions. Now, IFRS 13 does not apply to share-based payments. It doesn't apply to leases. So anytime you see fair value in share-based payments or you see fair value in leases, it is not this standard that determines how that fair value should be determined. Okay. So fair value is also the amount that will be paid to transfer a liability. If I owe somebody 15 million and I'm paying interest of 5% every year, but I don't want to pay the 5% interest. I want to just settle off the obligation. What I can do is I can look for somebody else that needs the money, maybe that needs this 15 million, right? Who needs 15 million? Pay the person 15 million, then the person will take over this interest payment and pay back the principal at the end of the period. So that's how companies transfer liabilities. You can sell liabilities, but when you're selling, unlike receiving money to sell an asset, you are paying money to transfer a liability because you're transferring that obligation to another party to take over. Now, the standard tells us that when determining fair value, reference must be made to an active market. Okay. There are two types of active markets, principal markets, most advantageous markets. Now, reference must be made to an active market. Reference must first be made to the principal market, and it's only in the absence of a principal market that the most advantageous market is used. Okay? Remember, both the principal market and the most advantageous markets are both active markets. What's an active market? An active market is a market where transactions for the asset or liability occur frequently, maybe daily, weekly, hourly, frequently. Well, I mean, what frequently there is subjective anyways, but you have an idea of what frequently means. Of course, maybe every day, every week, every month, depending on the kind of assets. There's some items that are sold every 6 months. There's some that are sold every fortnight, every 2 weeks. So as long as the transactions occur frequently, they're active market. Now, the principal market is the market with the greatest activity. Now, this is where it is relatively defined. Greatest activity. You didn't say with an activity of once a week or once a day or once hourly or every second. It just says with the greatest activity, meaning you have to compare with other markets to see which one has the greatest activity. This makes it easier to apply across different countries. So in a particular location, my principal market might be different from another company that is doing the same thing in another location. Okay? So the principal market for the same asset can differ between entities, right? Due to restrictions imposed on some entities to sell in some markets. So whatever market you have access to is the market to consider. If you don't have access to such markets, for instance, if you want to value the sale of bonds and you're selling in a secondary market, but you're not registered in such markets, meaning you can't sell in such markets, you can't use that market as a reference point to determine what you will get for selling your bonds, for instance. So principal market is the market with the greatest activity, while the most advantageous market is the market that maximizes the net amount received from selling an asset or minimizes the amount paid to transfer a liability after considering transaction and transport costs. Now, principal market is simply volume, how many items are sold. Now, if I have 5 markets and 3 of them have the same level of activity and the remaining 2 have a lesser level of activity, there is no principal market because they're all at the same level. They all do the same volumes. That is when I then consider the most advantageous. Which one maximizes the net amount received? Meaning if I'm to sell the asset, which one will give me the highest value? If I'm to transfer a liability, which one will also give me the highest value? Meaning which one will I pay the minimum for to transfer a liability? So, and when you are doing that, you consider transaction and transport costs. But after considering the transaction and transport costs to determine the most advantageous market, when you want to get the fair value of that most advantageous market, they are not adjusted for transaction costs, only transport costs. So this point is going to be made clearer when we do some questions. So note that transaction costs are legal and broker fees, while transport costs are costs to deliver the asset to the market. Now, IFRS 13 principles on fair value measurement. Now, when determining fair value, the following should be assumed according to the standard. The standard says that market participants are knowledgeable and they are not forced into transactions. Okay? Meaning that nobody should be forced, because once you are forced, you're not going to negotiate in clear terms. Buyers and sellers should be independent of each other, so we'll get the most realistic and reliable fair value. buyers and sellers should be capable of entering into a transaction, because if it's an illegal transaction, then the fair value will be sort of skewed. And the standard tells us that there are various approaches to determining fair value. We have market approach, cost approach, income approach. Now, market approach are basically, you are looking at the market for identical or comparable assets or liabilities. That's what your valuation is, recent sales price. So what can I sell this item for? Who has sold this item similarly in the past, with this market? Cost approach. This is when valuations are based on current replacement cost, which is the price to sell the assets adjusted for obsolescence. Okay. Now, a lot of times for physical assets, you use cost approach because you want to look at what it would take to sell this particular asset that has been used or that has sort of declined in value. Okay, so that is cost approach. Income approach is when you're basically doing valuations based on forecasts. Okay, you are converting future amounts to determine, it's like you're discounting future cash flows to determine the value today. Now, the standard does not give priority to any one of the above approaches, but it states that whichever approach is used, always maximize observable inputs. Observable inputs are inputs that you don't manipulate. They're basically market data. You get them from the market. You get them from what the market is saying. Because if you use unobservable inputs, which are inputs within the company, it is prone to manipulation. Okay, so the standard says minimize the use of that and maximize observable inputs. Now, the standard now, because over time, different people were not really clear about that note, the standard then gave further guidance around it to say, whenever you're determining fair value, follow a 3-tier fair value hierarchy. This 3-tier fair value hierarchy simply prioritizes which input methods to be used in determining fair value, to be sure that you've exhausted all market options before you now rely on your internal forecast. So we have level 1 inputs. Level 1 inputs are basically market quoted prices. When we say observable, we're talking about markets. What are the market quoted prices for the identical assets in active markets? And you must always consider this first. It is when you can't find observable, meaning market quoted prices for identical assets or liabilities, you then go to level 2. There are market prices that are not level 1 inputs, which could include quoted prices for similar assets in active markets, or market prices, that's quoted prices for identical assets in less active markets, or other observable inputs other than price, like interest rates. Always try to pick some form of market data in determining your fair value. Remember, level 2 input does not mean cost approach or market approach. You could use any one of the 3 approaches. Of course, if you're using level 1 input, it's strictly market approach, right? Because you're looking at market quoted prices. For level 2 inputs, you can use income approach for level 2 inputs. You can use income approach. For level 2 inputs, you can also use cost approach. So indirectly, the standard is already prioritizing market approach in that sense. For level 3 inputs, they are basically unobservable inputs. They are not market data. Okay, they would include cash or profit forecasts using an entity's own data. Okay, level 3 inputs meaning you should only use your own data as a company when you've considered level 1 and level 2, and those cannot be determined, meaning you cannot still determine your fair value using level 1 and level 2. So there are other principles that the standard says, such as that the fair value of a non-financial asset like PPE, intangible asset, any other asset should be based on its highest and best use. Okay? Highest and best use. And this highest and best use is the use that a market participant would adopt in order to maximize its value within what is physically possible, legally permissible, and financially feasible. Because sometimes the highest and best use from a realistic perspective could be illegal. So it needs to be legal. And also in determining the fair value of a liability, the assumption of the value of transfer, not settlement. Because what you are doing is basically you're transferring that liability to another party. You are not settling the liability. So the fair value there should not be the price it takes to settle the liability, but the price it takes to transfer to another party. Very, very important. The examiner has not really tested fair value of a liability in the past. So it's a very, very examinable area in the future. Maybe not now, but definitely sometime in the future. So that's the nutshell of those three standards. They are standards that should be known for every SBR question because they can come in at any point in time.